everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, December 17th, 2022, and I appreciate you coming to my podcast of the Gossett and Trading Weekend Review. In this podcast, what we're going to do is, first of all, we are going to take a look at all my current trades, trade activity from last week, why I entered the trade, when I entered the trade, and most importantly, how I am going to manage that trade going forward. After that, we are going to talk a little bit about trader psychology. Always the most important skill in trading is the ability to create a plan and follow it and not let your emotions get amplified and get you off track. After that, we're going to do a quick poem from my good friend Frank, the trading poet. Always think they're kind of fun and pertinent to what's going on in the market and also helpful. And then I have gone down through my master watch list, and I do have some potential trades that I'm looking at next week, both on the daily and the weekly time frames. As with any trading, what you want to do is you want to look for confluences, combination of entry signals and supports lining up together, ideally on multiple time frames, looking for those support levels where you have a good idea that buyers will be coming in, and more importantly than that, it just gives you a good line in the sand to structure your trade from a risk to reward standpoint. Position sizing based upon the market's current volatility, giving yourself a good risk to reward ratio based upon the support levels that you have. Of course, placing your emergency stop, having your end of day stop. I like to take profits. If the trade does go my way, I like to take partial profits as the market is giving me something. We have to be aware of significant overhead resistance levels. We need to have a trailing stop process in place so that if we do have a trade that goes our way, we don't give it all back and we mitigate losses if it moves down. So, trading is not that hard once you have a process, and there are many processes. Whatever I teach you, it does consist of good trading principles, but there's all sorts of different ways to trade. My way of trading is not the only one. Obviously, there's thousands, tens of thousands different of approaches and strategies, but what it really comes down to is having a good risk to reward ratio, positioning your position size, or creating your position size based upon what the market is doing as far as volatility. More volatility, the fewer shares you're going to buy. The less volatility, the more shares you're going to buy. And then, like I mentioned before, having your emergency stop, end of day stop, taking partial profits, knowing where your overhead resistance levels are, and having a trailing stop process. So usually whenever I'm looking to enter a trade, the price action has to either go down to find some support, or it has to go up to show me some kind of momentum situation that's going on. But always risk to reward is the most important. So like I said, I did go down through my watch list. I'm going to go down through what I'm looking for next week on the dailies, and then we'll switch over to the weekly time frames as well. And then of course we'll take a look at the current positions that I took this week and how I'm managing them and how they are doing. We had a tough week last week. We had the FMOC meeting and CPI. Markets rallied definitely on the CPI number, but boy, it has been straight down since then. So it's been a tough week, and but we'll get into how I'm looking at these markets, what levels that I'm looking at. Okay, but before we get started, I have to run the U.S. legal disclaimer. So I'm going to do that now. Give me about 40 seconds, and I'll be right back. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's get started. Okay, I'm going to go through the daily trades that I have. Kind of a bad week, but we don't always have great weeks, unfortunately. But the key is, even if you have a bad week, the ultimate goal is to mitigate the loss. And so if you do have a losing week or you do have a losing trade, you get out quickly. We have to have large gains in trading occasionally to pay for all of our little losses. And you are going to have a lot of little losses. And this week I did as well. So let's start with Berkshire Hathaway. I like Berkshire as a company very much. I did buy Berkshire back here on the 15th of December, which was Thursday, when we had an intra-bar rejection of the 200 SMA. The 200 SMA is a strong level of support. Generally, you have a lot of institutional buyers and sophisticated traders come in and buy at the 200. And on Thursday, we went well below the 200, and then we closed back above the 200, giving me a very, very good risk to reward ratio. Now, whenever I enter a trade, I position size based upon the 2 ATR. That helps me position size for volatility. And I did take a weekly trade on the VIX, and I'll go through all those numbers when we get to that position. I'll go through all those numbers of how I position size, where I place my emergency stop, where I place my trailing stop. But in general, whenever I take a trade, I enter at a level of support, which I did at 302.60. I position size using the 2 ATR. I place my emergency stop 2 ATRs below, and then I place my trailing stop level 1.5 ATRs above my entry. Well, that did not come into play, and this was a one-day wonder where I got in at 302.60, and it did close below the 200 SMA at 300, and I got out at 330 cents for a loss of 0.79. Not fun to take a loss, obviously, but the key is you are going to have them. I am going to have them, and you have to get out when the signals tell you to get out. And my signal was to get out under the 200-day moving average. Now, can this just come rocketing back up next week? It sure can. But I can always get back in if I have another close above the 200. I mean, if we're going to go back up to, 323, it obviously has to move above the 200 to do that first. But right now it's underneath it. It has resistance above it. And, it might just continue down. In which case, I'll be very, 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 very happy that I got out when I did. Or if it moves back up, then I have the opportunity to get back in. So don't fight the market. If you get out, if you have a signal that tells you to get out, just go ahead and get out. You can always get back in. So again, this was a loss on BRKB of 0.79%. Tesla. Okay, I did buy Tesla again on Thursday, same time I bought BRKB. What was my signal? Well, I had multiple signals on this trade. I had an under 30, over 30. That was the main signal of the day. I also, Tesla also bounced at the negative third ATR channel, which is significant because 92% of prices do hold at the negative third ATR channel. That does give you an edge. And then we also had a V1 entry trigger. V1 entry trigger consists of two bars, bar 1, bar 2. Bar 2 has to go below the bar, below bar 1's low, and then close above bar 1's close. This is a very good setup. And I felt pretty comfortable that this trade was going to go, especially being that on the particular day that Tesla had this signal, it was a very strong down day, and Tesla actually ended up. So there's relative strength that also came into play here. Monday to Friday, we headed up, and I felt pretty confident about the trade, but then we had a big sell-off, and I took the trade because of an under 30, over 30 RSI reading, and then we closed below. You can see over here is our RSI level 2862. So if I take you back to the day that I entered, you see we're 3168, but we were much lower during the day. So we went below 30 RSI and then closed above 30 RSI, in addition to the bouncing at the negative third ATR channel, in addition to the V1 entry trigger as well. And then on Friday, unfortunately, it didn't work out. It closed back below the 30 RSI, and that was my exit signal. And you can see, got in at 157.40, got out at 151.10 for a loss of 3.97%. So never fun to take a loss, but what's important is that you find that support level, you set the trade up, and if your process tells you to get out, if something happens, then you just go ahead and get out. Now, it's 2862. Monday, if we rallied for some reason and gets back above 30, I would certainly consider taking the trade again. But that's why when I talk about trader psychology, about getting out of your trade when you're supposed to, it's not that hard. Very black and white. It tells me to get out, but you know how we are as humans, right? Like we want to go, well, maybe it'll go back up. I think I'll just hold here. Hope springs eternal. But in trading, you really should not have hope. You should just move, or you should just take the trades and manage the trades based upon what your rules were. And I'll talk about this a little bit at the end, but I talk about all these different signals, V1s, V2s, RSI levels, 200-day moving averages, and I do my best in this podcast with the limited time that I have to explain. But if you are interested in learning this all step by step, so you really know how to do this for yourself, then I do offer private one-on-one lessons in the evening times via Skype. I have a 15-hour course, 5 sessions. Each session is 3 hours. That gives you the 15 hours. And I really do believe the best way to learn anything, whether it's trading or tennis or the violin, is to have a one-on-one instructor mentor that can really teach you. And I really enjoy teaching. I teach people from all over the world. I have many students at the moment. And I really enjoy seeing them learn this, and I can do the same for you, and I look forward to it. So if you're interested, I have my email in the description of this YouTube video. All you have to do is reach out to me, and then we'll set up a Skype call, and we'll talk a little bit about your trading. You can ask me a little bit about the course, and it's not a sales call. It's just to get to know you better, learn about your trading challenges, what you hope to achieve. So if that is of interest to you, please email me. And again, I'll talk about it a little bit more as we get closer to the end of the podcast. So loss on Tesla of 3.97% on the daily, but I am looking at Tesla. I will keep following Tesla, and if we get a close back above the 30 RSI on Monday or anytime next week, I will probably re-enter the trade. VIX. All right, so this is this is an interesting trade and a little bit frustrating of a trade because I did take the trade back here on 12.5, very similar to the setup I had in Tesla where I went under 30, over 30 RSI. That was the main entry signal. The contributing factors that added a little cherry on top here to the trade where we rejected the negative third ATR channel, and we also had a V1. I keep talking about V1s, V2s. So I did enter at 1458. I position size based upon the volatility. I placed my emergency stop 2 ATRs below, and then I placed my trailing stop level. And remember, at the beginning of the podcast, I told you whenever I have a move up from the previous day's close that moves the distance, the value of at least 0.45 ATRs, I take off 10% of the trade. I like to play offense and defense. The defense are the trailing stops, emergency stops, end-of-day stops. The offensive part of my game is taking partial profits as it moves up. So if it does come back down, I've locked in some profitable, a portion of my position at profitable levels. And then if it does come back down, it mitigates any loss. So this is an interesting trade because I have a rule. One of the rules I use when I take an under 30 over 30 is if it ever gets to my trailing stop level, then if it ever comes back down to my entry point, I'm going to get out at break even. Okay, under 30 over 30s, I love them, but they are vulnerable to bouncing and then failing again, and that is why I've implemented that rule. So I did get in here at 1458. Next day, we had a nice move up, took some profits off. From this day here, the 8th to the 9th, also took some profits off, which I'm glad I did because then we came back down to my entry point. And so this shows a 1.46% loss. And you might say, well, Greg, if you got to entry point and then or to trailing stop level and then it comes back to entry point, wouldn't it just been break even? Well, normally it would have, but you always have the risk of a gapping below your entry point, and that's exactly what happened. So I can't help that. I got out immediately at the open because I knew it was under my entry point. So I got out at 14.38 for a loss of 1.46. And then, of course, we moved down lower, and I thought, oh, that was a good exit. But then we rocketed back up. But what am I going to do? But I did enter VIX again on the weekly chart, and I'll show you that. So let me go back here to here so we can clear these levels so the charts don't get too busy for you. All right. And here's Tesla. We just went over that one. And then we also went over VIX as well. All right. But I do have, yeah, 1497. Okay. Sorry, I should have done this before. My apologies. Take that off because I'm going to show you exactly how I set up, in detail, how I set up the weekly trade on the VIX. 1497 was my entry. Sorry, should have done this before. All right. Next trade, DoorDash. All right. Well, again, this gives a good example of the rules that I use. And this is actually a great example. I did buy Dash with a higher low V1. Rules on a higher low V1 is we have to close below the value zone. We have to come into the value zone. The value zone is between this green line and that green line. This is just one standard deviation from the mean. This is -1 standard deviation from the mean. So we came into the value zone, came back down, created a V1. Here's bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. That gives me the higher low V1. Entered at 55.10. Next day moved up nicely, took profits. Believe I took 20% off on this particular trade. And then Tuesday when we had the CPI, it gapped way up, which was great, and I hit 3 profit targets on this trade. So, you know, if you're following along here, 2 profit targets and 3 profit targets, each one 10%. That took me out of 50% of the trade here at this open. Well, 20% here and another 30% here at the open. Now, whenever I take a higher low V1 or V2 and it gets to my trailing stop level, I have the same rule as I did back with VIX. If it reaches my 1.5 ATR trailing stop level, if it ever gets back to my entry point, I get out of the trade. And that's exactly what I did. Here, here's the 1.5 ATR trailing stop level, and then we came all the way back down. I got back out at break even at 55.10. So was it a positive trade or a negative trade? It was positive. And why? Because I took the profits when I had them using the offensive approach. Makes sense? And so yes, the 50% that I had left, I sold at break even, but I took profits on 50% of the position as well. And then of course, yesterday was a huge move down, and luckily you see how the rules that I have here saved me from keeping this and dumping 4.94% on Friday. Yeah. So this is a good learning example to show why taking partial profits can really help you in the future. And that's what happened. So higher low V1, scaled out, got to trailing stop level, came back down to my entry point. Those are my rules. If I move 1.5 ATRs and then get back to break even, get out. And then on Friday, this went down here. So good example of using offense and defense maneuvers in a trade like this. UUP. All right, UUP. I did buy UUP all the way back here on the 2nd of December with an intraday rejection of the 200-day moving average and also an under 30 over 30. Nice setup. Next day bounced, took some profits. Of course, I position size, place emergency stop. Where's my end of day stop on this one? Just simply a close below the 200-day moving average. That's my level. But next day moved up nicely, took some profits. Then it just kind of moved sideways. There were no more profits to be taken. And then back here on the 13th of December, it closed below the 200-day moving average. So on this particular trade, got in at 28.23, got out at 28.13 for a small loss of 0.3 0.39%. And yeah, it has moved back up since I've sold it. But if I want to get in this trade again on next week, just simply a close over the 200 would do it. All right, so those were all the daily trades. Those ones were losing trades, unfortunately, but weeklies are looking a little bit better. I did buy IWM on the weeklies. Now, weeklies close on Friday, right? The weekly bar closes on Friday. What was my entry signal on IWM? Well, here, the orange line here is the 300-week moving average. That was my level. It went below during the week, closed above it at the end of the week. I got in at 167.19. If I position size, I placed my emergency stop, I placed my trailing stop level. So got in at 167.19. Again, as the bars move up, if they move up, the value of 0.45, I always take 10% off, and that's exactly what happened. So the next week, took some profits off there. Next week, took some profits off there. Nothing the week before, or the next week, then we had the big move up, took more profits. I did get to my trailing stop level. So if I get to my trailing stop level and then have it close below the previous bar's low, I get out. That happened last week. This was the first bar that closed below the low after reaching the trailing stop level. And on that particular trade, I locked in about 6.65% on half of my position. All right, and got out of half there, locked that in, trailing stop level. Now, of course, this week went down further, but on this particular trade, I'm still in because my trailing stop or my end of day stop here is the 300 weekly SMA, and it is still holding above that. So the half that I have remaining, the portion that I have remaining in this trade is up 4.22%. All right, Microsoft. Here's my signal. Bounce at the 200-day moving average on the weekly. Position size, emergency stop. Where's my end of day stop? A close below the 200-week moving average. Of course, as it moves up, I'm going to take profits. The next week had a big move up, hit 2 profit targets here. Then we had a couple of weeks of sideways motion, had another move up here, took 1 profit target. At the beginning of this week, hit another profit target, so I took more off the board. I am above the 1.5 ATR trailing stop level, so now I am just looking for a close below previous bar's low in order to get out of half of my position. That did not happen last week. Last week's close did hold above the previous bar's low, so I am still in the position. This particular trade up 9.51%. And again, lots of different rules here, right? You're like, well, wait a minute. You got up to 1.5 ATR trailing stop level, or you rejected the 50 RSI level, but you got out of one on one trade and you didn't get out of one on the other. That's true because I have different rules based upon the different entries that I take. And so that's what I try to explain this here, but I understand sometimes there's a lot of rules here, and that's, again, what I do teach in my one-on-one lessons. But nonetheless, Microsoft, still a good trade here, up 9.51%. Joe, is coffee. Okay, well, why did I buy coffee? Because it bounced at the 200-week moving average. I got in at 44.28. Position size, place my emergency stop, place my trailing stop level 1.5 ATRs above. Next week moved up, did take some profits, a couple weeks of doing nothing. Last week moved up again, did take some more profits off at profitable levels. It's still holding above the 200-week moving average, so I am still bullish. This particular trade currently is up 5.86% from entry. TLT, wow, this has been a monster trade here. Really has been a monster trade. Why did I take the trade? Well, on this particular trade, the signal was an intrabar under 30, over 30, plus a rejection of the negative third ATR channel, plus a V1, right? So entered position size, emergency stop, entered at 97.70, placed my 1.5 ATR trailing stop level above. It has got there, right? Last week, I locked in half of the profits because it went above the 50 RSI during the week and closed below the 50 RSI at the end of the week. So that particular, the half that I took off there was a pretty healthy 8.2% that I locked in half of, but I kept the other half, right, as per my rules. And currently right now, the other half is up 8.69%. Now, if in the because I'm at trailing stop level, if I get a close below a previous bar's low, I will get out of the other half and then I will be out of the trade. Or if it comes up and rejects this 50 SMA up here, that would also be a signal for me to lock in the other half of the trade. But very grateful for this trade. It's been a good one. Second half that I have remaining here is up 8.69%. GDX has also been a really nice trade. Bought this back here on the 4th of November with a higher low V1 in the value zone. Love higher low V1s, love higher low V2s. And I did enter here at 24.90. Now, your stop on a V1 or a V2 is going to be halfway of the washout bar. So this is my end of day stop here. I don't have a 200 or a 250 or a 300 SMA to key my end of day stop off of. So I use halfway of the washout bar on a V1 or a V2 for my end of day stop. So entered here on 11.4 at 24.90. Of course, the next bar moved up nicely, took partial profits as always. Then we had a couple weeks sideways, and we had another big up move where I took another 10% off. But then at the end of the week, it rejected the 50 SMA here, and that was my signal to get out of half. And I did get out of half roughly for a 16.58% gain, which was pretty dang sweet. And then today, Friday, I exited the entire trade because we had a close below the previous bar's low after reaching trailing stop level. So the first half I took off with the rejection of the 50 RSI. I'm sorry, not the 50 RSI, the 50 SMA, excuse me. And then I got out of the second half of the trade with a close below the previous bar's low. So I am now flat. I am now out of GDX. But the second half, I locked in a 12.9% gain. So pretty sweet there. And again, I am done with GDX at this point. VIX. All right. I told you that I took a new trade, weekly trade on VIX. Why did I take it? I haven't marked any of this up because I had the other position I needed to show you, and I didn't want to have too many lines to confuse you and me. And so, yeah, I took this on Friday to the long side. Why? Well, we're at a 3173 RSI, but during the week, we went below 30 RSI. So this is a weekly trade. This is a under 30 over 30 on a weekly basis. So I wrote the number here. I got in at 1497. So let's just set this trade up. This is what I do every day. So 1497, let's change that. There we go. That is the entry point, 1497. Now, how many shares do I buy? Well, what I like to do, a good rule of thumb for me, if you take 1% of your trading capital and then divide that amount by the value of the 2 ATR, that will show you how many shares to buy. And it adjusts for volatility of what the current volatility is. So let's just say I have a hypothetical $100,000 trading account. What I do is I times it by 0.01, which is, of course, is going to be $1,000. If you have a $50,000 trading account, then 1% would be 500. If you had a $25,000 account, right, it'd be 250 or so forth and so on. If you have $1 million trading account, it's 10,000. It's all the same, but for this hypothetical, let's use $100,000 trading account times 1%. That's $1,000. I would take $1,000 divided by the value of the 2 ATR. Currently, the value is 343. So divided by 3.43 equals, it would tell me to buy 291.5 shares. I'd round that up to 292 shares. All right, that's how many shares that I'm buying. Then the next thing I do is I have to place my emergency stop. Well, my emergency stop is always $3.43 below my entry. So we'll go here. Well, what did I say? 343. Sometimes it's hard to get exactly. Yeah, so it's going to be roughly there. That is my emergency stop. So if I have 200 and, let me grab that number again. Let me put this up first. Okay. So if I have 252 shares and it moves down 3.43, how much is that? It's $1,000, right? So my emergency stop is configured to tell me if I get to my emergency stop, I know exactly how much I have lost. And so that's a very important part. Now, why did I take the trade under 30 over 30? So my end of day stop will be what? It will just be simply a close next Friday below the 30 RSI. That's it. Or if it gets to my trailing, or if it gets to my emergency stop, I will get out whenever, Monday at the open, if it's down here. So my end of day stops 90 95% of the time you're going to use a end of day stop to get you out of a trade. But in the worst case scenario, and you're going to wait until the bar closes, whether that's a 2-minute bar or whether that's a daily bar or a weekly bar or a monthly bar. Okay. But if I ever get to my emergency stop, then that's an immediate situation. So under 30 over 30, I like that we're near the negative third ATR channel. Position size correctly using the 2 ATR, place my 2 ATR emergency stop level below. And then the last thing, I have to put my 1.5 ATR trailing stop level. Right now, 1.5 is $2.57. So if we get up here to 257, it's going to be slightly above there. Then I will go into trailing stop mode, in which I change my process and how I get out. But until I get there, nothing changes, and it's just based upon me, the position holding above the 30 RSI, and right now it's 31.73. But if I get to trailing stop level, then I have other rules that go in place, like getting rid of half if I have a close below previous bar's low, or if I reject the 50 RSI, or if I reject the 50 SMA. So I know a lot of rules, but I think what makes a good trader is how they manage the position, and that's why I've spent basically 28 years in my trading career working on managing the position, not just getting in the position, but managing the position. All right, so that's the new trade on VXX. Last trade on the weekly, this one was a losing trade. This is QQQ. This is the NASDAQ 100. I bought this back on 11/11/2022. Close under, close over the 200-week moving average. Also had a nice V2 signal here, which is good, which is great, right? Confluence combinations signals entered, position size entered, emergency stop down here, end of day stop, just to close below, or the weekly close below the 200 and trailing stop level. Well, moved here. This trade just didn't really do much, didn't hit any profit targets, but Friday we closed below the 200-week moving average, and that told me to get out of the trade. So I am now out of the trade. Had a loss of 4.17%. But next week, if we have a close back above the 200-day moving average, I would certainly consider getting in again. So let's take that one off. Okay, last trade. This is on the monthly, so the month is not over yet. And so at the end of the month, I will make a decision. Why did I buy Intel? Nice confluence of signals, about as many signals as you can get. Under 30, over 30. We had a close under, close over the 200-month moving average. We had a close under, close over the negative third ATR channel. Got in at 28.21. This is about one of the best setups I could ever take, right? We had under 30 over 30. That's one. Had a close under, close over the 200. That's two. Had a close under, close over the negative third ATR channel. That's three. And then had a V1 entry signal. That's four. Four signals on this trade. And the next month, so I bought that at the end of the month. The next month it moved up. Luckily, I took 10% profit, right? Took it off. Helps mitigate my loss if this turns into a losing trade. And then we had a close. Right now, we are currently under the 200-month moving average. It's not the end of the month, but at the end of the month, if we close under the 200, I will simply get out of the trade. And that's how it goes. This particular trade from entry to exit currently down 5.31%. So weekly trades doing pretty good. Very grateful that I had some good ones there. All the daily trades this week, just no good, but try to keep the losses small. That's the only thing you can do. And we'll see what happens going into next week. Okie dokie. Let's get over to a little trading psychology from one of my favorite posters on Twitter, the Divergent Trader, Alan Edwards. Please follow Alan at Trader Divergent over on Twitter, and always love his posts. They're always relative to what's going on with the market and just good trading psychology, good trading words of wisdom. 4 things you will never regret doing, and there's a lot of regret in trading, isn't there? 1, trust your plan, not your emotions. I'm telling you, I've traded for 28 years, everyone. If you follow your plan, you're going to do better than if you trust your emotions. I just think that's it. I think that is the most true statement in trading ever. It's fun to trade on your emotions. I get it. And sometimes you do fine with them. But overall, in the long term, you will do better if you just trust your plan, not your emotions. And your plan, again, should consist of good support levels, position size for volatility, knowing where your end of day stop is, knowing where your emergency stop is, knowing where significant overhead resistance levels are. That's the key in having a process, taking profits, trailing stops. That's what I mean by a plan. So 4 things you'll never regret. 1, trust your plan, not your emotions. Got it? Focus on the present, not past trades. Of course, things in the past are going to have an effect, or they're going to try to have an effect on us, what we're doing in the present. But those trades are done, right? If you've had a bad year trading this year, so be it. You can't change that, but you can change the future. Focus on the present. Don't let what has happened in the past affect what you're doing in the present. And, these two work together. If you've had a bad year, don't focus on that. Focus on the present and trusting your plan now, okay? Focus on the process, not the outcome. You hear this a lot, but it's true. Of course, the outcome is we want to make money. But to really make money, what you need to do is focus on the process. If you focus on the process, if you focus on mitigating risk, that's when the profits come. If you focus on making money and that's all you care about, unfortunately, it's going to have the opposite effect. But if you just focus on the process instead of making money and following that process step by step, that is how you are going to make money. That is one of the great paradoxes in trading. Focus on the process, you'll make money. Focus on profits, you'll lose money. And last, work on your mindset, not the next hot strategy. Mindset is everything in trading, everyone. It is. And it relates back to the first 3. Trusting your plan, focus on the present, focus on the process. That's your mindset. That's the mindset you should have. So one more time. Trust your plan, not your emotions. Focus on the present, not past trades. Focus on your process, not the outcome. And work on your mindset, not the next hot strategy. Isn't that great? And it's so true. Thank you very much, Alan Edwards. Please follow Alan at Trader Divergence. Okay. Lastly, before we start taking a look at potential trades for next week, Frank, please follow Frank over at Frank OD, the trading poet. Today's market poem. The best gains are the ones you've never asked for. Isn't that true? That bonus, special dividend, profit, and more. Maybe the stock you've been holding that opens higher times 4. That's nice when it happens, right? How sweet it is when unexpected money flows to us galore. This has happened many, many times in my trading. The ones that I think, oh, this one's really going to work, somehow don't work. Sometimes the one that you don't even think about, and you don't put a lot of weight into, those are the ones that open up times 4. And it's like fishing. I don't fish, but I know from fishing that, you put your line in the water and every once in a while you get a big one, right? You get a big one. And that's what happens with trading. So the best gains are the ones you've never asked for. That bonus, special dividend, profit, and more. Maybe the stock you're holding that opens higher times 4, how sweet it is when unexpected money flows to us galore. And you will have these. You will have these unexpected monies in trading. You'll have some news. You'll have something that happens where it will gap open. By 4 would be awesome. I've never had that, but it is true. And follow your process, and every once in a while, you are going to have some big ones like this. All right. Okay. Let's go over to the dailies for next week of what I am looking for. Apple. Well, Apple has really taken it on the chin like a lot of things last week. You can see the 200-day moving average really did act as resistance. We would have been a great short here with the rejection of the 200 and good risk to reward ratio. And boy, it would have paid off handsomely. But yeah, Apple is extremely weak at the moment. What am I looking at next week? The way I look at this chart, the first thing I look at is, ooh, look at this. We're near the negative third ATR channel. Again, 92% of prices tend to stop going down, go sideways, or go back up once we get to this level. So that is an important level that I always look at. You can see here we got very close at that previous low before we bounced, and we're right about the same distance from it now. We're at a 35.85 RSI. I really like Apple as a potential here, or as my good friend Ava would say, nibbling on some Apple here, but I still need the signal excuse me, to get into the trade. What would my signal be? We're near the negative third ATR channel, but just because that happens doesn't mean I'm going to get in the trade. But what I'm looking for next week on Apple would be a close under 30, back over 30, or an intraday rejection of the 30 RSI and then back over. So really, really looking for Apple here. Of course, love the company, but I just need the proper signal. Right now it's 35.85. I just need it to go under 30 and then back over 30 RSI. If it does that, it will also go under the negative third ATR channel and back over the negative third ATR channel, looking for a confluence. Let's look over on the weekly, see if we have any levels there. Well, we have the second ATR channel down here. So if we do move down into the 30 RSI level on the daily, we'll most likely be very close to the negative 2 ATR channel on the weekly. That would be a confluence of signals. But I really, really do like this trade, this potential trade setup on Apple with an under 30, over 30, and a rejection of the negative third ATR channel. One of my favorite ones for next week. Amazon. Amazon, not quite as low as Apple. You can see we're not quite as close to the negative third ATR channel, and we are at a 38.03 RSI. So Amazon, relatively stronger than Apple, but what I would be looking for on Amazon next week is simply an under 30, over 30. Now, if Amazon happened with an under 30, over 30, and Apple also went under 30, over 30 on the same day, which one I pick? I would probably pick Apple because it would have the confluence of the rejection of the negative third ATR channel. So, a lot of times I have, 12 signals here. I mean, these could all signal potentially all in the same day, but I generally like to only take the very, very best one of the day, the one that has the most support on the daily and the weekly, the most signals on the daily and the weekly. And so Apple would be my favorite, but who knows? They're not going to move exactly together. So Apple under 30, over 30 in rejection of the negative 30 R channel, I think would give you very good risk, or give myself a very good risk to reward ratio. Amazon, just simply an under 30, over 30. Berkshire Hathaway, well, I of course just got out of Berkshire with a loss on Friday with the close under the 200. But next week, if we close back over the 200, I would consider re-entering the long position to Berkshire Hathaway if a close over the 200. Conversely, we're at a 42.52 RSI. If we went under 30, over 30, that would be a level to the downside. So a close over the 200, I would be interested in Berkshire Hathaway, or conversely, an under 30, over 30, I would also be interested in getting long Berkshire Hathaway. Diamonds. Okay, so this is very interesting. This is something that I have been looking at, I have noticed for many, many years. Do you see how here's the 50 SMA and we have the 100 or the 200 SMA? Well, 2 days ago we had a golden cross. That's when the 50 crosses over the 200. That by itself is a decent long-term moving average crossover. However, what I've noticed is that when you have a moving average, or when you have a golden crossover, 50 crossing over the 200, when that happens, a lot of the times I see the price move down still, even though the trend change, if you want to call it a trend change using the moving average crossover, happens, often I see it move back down. So I really like the fact that we had the golden cross, the 50 crossing over the 200, but what I really am looking for, and what I kind of would expect, is that if I could get any kind of rejection off of the 200, either a close under, close back over, or an intra-bar rejection of the 200, that by itself I would buy. But in conjunction with the golden cross happening here, I think that makes that trade stronger. Now, the Dow has been much stronger than the rest of the indexes. Of course, it has sold off, but I really like this trade of any kind of intraday rejection or close under, close over of the 200, especially in the combination where we have the golden cross happening here. So I'm going to be watching this very closely next week, looking for any kind of rejection of the 200-day moving average as an entry point in conjunction with the golden cross that we've just had. Gold. Okay, so gold, I'm looking to the short side. We have an abandoned babies up here. You might say, what is abandoned babies? Well, abandoned baby is when you have some prices that have a gap to the left and a gap to the right. This is a bearish abandoned baby because we have the two, it's also called an island reversal, but we have two bars up here with a gap to the left and the gap to the right. Now, this would have been a legitimate trade on Friday with the rejection of the 200, but what I'm really looking for is I'm looking for a move back up and rejection of the 300, either a close over, close under, or just an intra-bar rejection of the 300. That is where I would like to get short, especially in conjunction and in context with this abandoned baby. Let me show you TLT to the upside. Now, of course, you know I'm still long TLT. Look at this. Do you see the abandoned babies to the left here? Where we have two bars, we have a gap to the left to the upside and a gap to the right to the upside. That is bullish. And was that bullish? Yeah, pretty dang bullish, right? Extremely bullish. That signal right there with the abandoned babies to the downside. Very, very bullish. So let's go back, put this in your mind, right? Two gaps to the left, to the right, higher. That led to this move. Let's go to gold. See the difference? Now we have the gaps to the downside. Does this mean for sure that gold's going down? No, it doesn't. But that strengthens the short side case to me, but I still need an entry signal. And the entry signal for me here would be some kind of rejection of the 300. Now, it might just head back down from here with the rejection of the 200, but I didn't take the trade. I would, of course, like to get it a little bit higher, but we shall see. But what I'm looking for next week on gold is a short with the rejection of the 300. But if, you know, people that are in metals, this is a bit of a significant bearish signal. Johnson & Johnson. Well, Johnson & Johnson really respected the 200-day moving average back here on the 14th. We closed under, had a close over, retested, moved up beautifully. Now, do you see the golden cross we had here as well? We have the 50 crossing over the 200. Love that. But what did I say? Whenever you have the 50 crossing over the 200 or you have a golden cross, I have noticed that if you can test the 200 after that has happened, that's usually a very bullish signal. Now we're quite a long ways. We're at 175.67. 200-day moving average down here about 171. Also dovetails with the negative third ATR channel. Don't know if it will make it here. Probably not. But if it does, I would definitely be buying J&J. That's what I will be doing if next week we get some kind of rejection of the 200. MasterCard been quite strong here. And what I'm looking for next week, there's multiple levels here of support and resistance. Here we have the 300 and the 250. See how they nested perfectly here together? If I get a rejection of these 250 and the 300s, I will enter here. Conversely, if we head down lower, I will also take a long trade with a rejection of the 200-day moving average. So on MasterCard, looking for a rejection next week of the 250 and the 300 or the 200. PayPal, been very, very weak, but look, we're at a 2940 RSI. We're getting very close to the negative third ATR channel. So next week, if we do have a close back above the 30 RSI, I would definitely consider getting long PayPal, just like I did with Tesla. Didn't work out, just like I did with some other ones that didn't work out, and they don't always work out. That's why it's important that you position size and you adhere to your process. So if we do have a close on Monday, for example, if we have a close over 30, we'll most likely also have a V2 signal, which again, something that I teach in my one-on-one courses. V1s, V2s are really kind of my bread and butter in trading. And by the way, I do have a free video on YouTube in my playlists section, my lessons and playlist section. I have a V1 and V2 instructional video on what those are like. So take advantage of that. I think the link to that is actually in the description of this video that I'm putting out today, this podcast that I'm putting out today. It's totally free. Go watch it and you'll learn a lot more about V1s or V2s. Okay, so right now we closed under 30. Not a great sign. But if we get a close back over 30, that will show that there were no more sellers under 30, and that's why I'd be interested in PayPal. Tesla. Okay, took the trade on Tesla with the under 30 over 30. Did not work, but we're at 28.62. We're at the negative third ATR channel. So if we get a close above the 30 RSI next week, I will definitely consider getting long Tesla again. UNH. Well, I like to look at the big moving averages and go, okay, which one was respected? Well, the 200 was respected. We had a close under 200, back over 200. That would have worked fantastic for a trade. Well, next week on UNH, you can see we got very close to the 200 at the low of the day on Friday, but it rallied. But next week, this is a nice kind of upward moving 200-day moving average. If I get a rejection of the 200 or a close under, an intraday rejection of the 200 or a close under back over the 200, I would definitely be considered getting long UNH. Walmart. Well, Walmart's been pretty strong, and we are well above the 200. Don't know if we are going to get all the way back down to the 200, but if we do, it's kind of a tall order. But if we do, I would definitely be buying Walmart. Give me a good risk to reward ratio of 200. Alternatively, it's at 39.71. If I have an under 30 over 30, I would also consider getting long Walmart with that. So an under 30 over 30 would get me interested in Walmart. A rejection of the 200-day moving average would also get me interested in Walmart. And then last on the daily, XLE, which is the energy sector, been very, very strong, but we have rolled over and have moved down. What do you think I'm looking for here? That's right. I'm looking for a rejection of the 200-day moving average if and when it gets there next week. If it doesn't, then no trade. But if it does, gives me a good risk to reward ratio. All right, well, let's take a look at the weekly setups. Again, weekly setups, weekly bars close on Friday, so I'm going to make my decision based upon the next Friday's close, right? So here we go. AGQ. AGQ is double leverage silver, okay? And I mentioned to you when I showed you gold that we had the island top reversal. We had the abandoned babies up there, and I felt like that was very bearish for the metals. Well, this is kind of confirming this on the weekly for me on AGQ. Here we have the 250, we have the 300, and we have the 200 week moving above average above this. Did not quite reject the 250 on Friday. However, by next Friday, if we have rejected the 250 or the 300 or the 200, that would get me short AGQ. And I always like to look at multiple time frames. If we switch, this is the weekly, so if we go to the higher time frame on the monthly, it plays out and it tracks because we have the 50-month moving average above us. Now that's going to act as pretty significant resistance just by inherently by itself. So I like to look at the longer time frame, which is showing me, okay, here's the 50-week moving average above. That's some resistance. Then if I look at the time frame that I'm actually going to be trading on, which is the weekly, I see the resistance. And you see how that 50 week, this is the line, the 50 month lines up perfectly with the 300 on the weekly. Now it doesn't have to be the 300, it's just in the general area, general context of the levels. So to make it simple, what I'm looking for next week, next Friday, is any kind of rejection of the 250, the 300, or the 200. That would get me short AGQ. Advanced micro devices. Okay, well, I like this particular trade. It was down 4.64% this week, so not a good one. We did have a close under over 200 that did hold. That was nice, that moved up. We also had a close under, close over the 200, which hung in there for a few weeks, then failed. But if advanced micro devices, I'm really looking at this for next week for two different reasons. One, if it moves up and we close above the 200, I would definitely take the trade because that gives me a higher low close above the 200. See, this low came from below the 200 and above. A lot of times those fail, and that's exactly what happened. But if you can picture this in your mind, if we close back above the 200 on Friday, that would give us a higher low close above the 200. That would be better than a lower low. Conversely, if we go down and reject the 250, I would take that again because last time the 250 really did act as support and respected that. So to make it simple for AMD, if we head down, a rejection of the 250 or the 300, if it gets there, I don't think it will get there, but it might, knock on wood. But if I get a rejection of the 250, that would be my more ideal trade. But if it does close above the 200, that would also give me a potential trade. But my ideal would be a rejection of the 250. That would be a higher low rejection of the 250, and the market AMD did respect it last time. So rejection of the 250, one option, another option, close back above the 200. Amazon, well, I talked about this on the daily chart, but it's also relevant to the weekly chart. We're at 35.24. If I go under 30, back over 30 somehow on Friday, that would get me long Amazon. Etsy has been quite strong. It's above the 200-week moving average. Not a lot of stocks above the 200-week moving average. But I don't want to chase it up here, and I think I've been talking about this for a couple weeks on Etsy. If we get back to the 200, if we bounce and show a rejection, if the market shows us that it does not want to close below the 200-week moving average, I would go ahead and take the trade. So that's what I'm looking for on Etsy. Is just basically a move back down. We had a big move up. Moving back down would not be uncommon, but it doesn't mean that it's heading all the way back down. But what I'd really like to see is the market to tell me and show me that, okay, we went under the 200, we didn't like it over there, close back above it, would just give me a good risk to reward ratio. Google, Googl, Google, well, looks similar to a lot of different markets we've already looked at. We made it above the 200. We came from a lower low. It failed. What I'd really ideally like to see on Google would be a retest of this 250 weekly. A close under, close over, or an intra-week rejection. Or if it goes down further, 300, of course, would be good as well. So rejection of the 250, rejection of the 300, or close above the 200 on the weekly. Intel, all right, I am already long Intel on the weekly. On the monthly. But what I wanted to do here was to show you that this is setting up for a beautiful higher low V2. And again, you can watch my videos. They're free in YouTube in the lesson sections on V1 or V2. But this is setting up for a nice potential higher low V2. Here's bar 1, bar 2. Bar 2 does go below bar 1. Next week, all we would have to do is close above the close of bar 1, and the close there is 28.24. So next week, if we had a close above 28.24, that would give me a higher low V2. Again, we close under the negative 1 ATR channel. We rally into the value zone. We have a pullback. Now, if we can get a new group of buyers to come in here and give us a higher low V2, that would be excellent. And again, this is what I teach. This is just one of the 5 strategies that I teach in my one-on-one lessons, and I'll talk about it at the end. But that's why I picked this, because I wanted to show you that this is a beautiful potential signal on Intel with a higher low V2. And of course, this is what I teach in my one-on-ones. But this is only good for one bar. This is only good for one bar. If we head back down, then it ruins the whole structure, and then we probably, you know, I didn't mention look at this way, but if we go under 30, over 30 on the weekly, I would buy it in a second on the weekly time frame, because then we would have a double bottom bullish divergence, meaning that we have a low here with deep red MACD bars, we rally into some green, and then if we come lower, I can already tell there are not going to be any red bars here, showing that this move down did not have the momentum that this move had, and this is what's called the double bottom and a bullish divergence. This is what I learned with working one-on-one with Dr. Alexander Elder. He believes double bottom bullish divergence is some of the strongest technical signals in trading, and I do not disagree with him, but they don't happen very often. But I can see this one shaping up here. I really can. So if we were to come down, go under 30, over 30, 100% I would buy it. And it may happen. Or if it heads to the upside, higher low V2 signal. So either of those. Russell 2000, I'm already in Russell. Down here at 167.19. But if I was not in the Russell, actually, if I was not in the Russell, this would have been a legitimate signal on Friday, because intra-week we rejected the 250 moving average. See that? But again, I'm already in this trade. My stop would be a close under the 300, but if I was not in this trade and it were to head back and close above the 200, it would give me a higher low close above the 200 and most likely a V2 as well. So again, if I was not in the trade, close over the 200 is what I would be looking for. That was a valid trade on Friday with a rejection there, or a rejection of the 300. The Qs. Okay, well, I just got out of the Qs because I closed below the 200. However, next week, if we close back above the 200, that would get me bullish again on the Qs, and that would be my entry signal. Close above the 200 would give me an entry signal, or if we head lower and we reject the 250, that would also give me an entry signal. SSO, double leverage SPY. We close below the 200, but not far below it. So if we have any kind of rally next week and close back above, that would give me a higher low, close back above the 200. You know, in general, it's very hard to see what the market's doing here, but we have had a significant move back down, and we had a significant move up. So we had a significant move up. To expect a little bit of a pullback is not out of the question. I mean, it may come down, test previous lows, but my gut is that we will probably find some kind of rally sometime next week, and that would coincide with technicals. So if we got to close back above the 200 next week on SSO, I would be long SSO. Tesla, of course. We're at a 32.14 RSI. We're getting very close to a 30 RSI. Boy, I think a signal on the weekly on Tesla down here off of the 250 would be an excellent risk to reward ratio with a good confluence of signals. What would the confluence of signals be? Well, they would be a rejection of the 250 and probably a rejection of the 30 RSI. So I would be Tesla looks very, very attractive to me here at about 135. Or conversely, if we close back above the 200, that would get me long on the 200 with a close over the 200 as well in the weekly. And then lastly, VIX. Oh, talked about this. This was the trade that I took on Friday. Under 30, over 30. That's the trade. So, you know, I've mentioned a few times about my lessons. I'm teaching so many students right now, and I see that they're really learning a lot. So I did want to talk to you a little bit about it. But again, if you want to learn how to trade, whether it's me or someone else, I really think the most important thing is that you learn one-on-one with someone that knows what they're doing, that's done it for a long time. And that's why I offer the one-on-one course. Now, the one-on-one course, it costs $1,750. So, you know, it's not a small amount of money, but you get what you pay for. And to be able to learn one-on-one and have your instructor teach you step by step for 15 hours, it's a really good value. It's really worth every penny. And usually do it once a week, so 3 hours a week for 5 weeks. And when you're done, you're going to know how to trade exactly how I trade. I'm going to teach you everything. It's very important to me that my students succeed. It's important for my brand. It's important to me because I want them to learn how to trade using good risk reward ratios and good support levels. So if you're interested, my email, is in the link of this description of this podcast. Just send me an email and say, hey, Greg, I'm potentially interested in taking your course. I'll say, great. Let's set up a Skype call. As I mentioned earlier, the Skype call is free. It's not a sales call. I can't reiterate that enough. I just want to learn more about you, your trading goals, your challenges, and it's a great time for you to ask me questions about the course. And when we're done with the call, then it's completely up to you. I will never contact you. But if one day you wake up and you say, hey, today is the day that I would really want to learn this, I want to take this seriously, and I want to learn from someone who's been doing it a long time, just write me back. We'll get it started and scheduled, and I promise you'll be happy that you did. Now, if you like online courses, I have a great online course available. It's very affordable. It's at udemy.com. The link's in the description of the video. And in that course, I teach you step by step how to trade the deep dip buy stock trading strategy. All the trailing stops, all the emergency stops, taking profits, all that kind of stuff. And a lot of the trades that I've been trading over the last months have been deep dip buys. So there's 9.5 hours of video there. There's 26 videos total. There's 15 study guides. And the best part, it only costs between $12 and $15. So, that's a good place to start. And actually, I recommend to all of my one-on-one students that they take that course before they watch that course, before they start working with me, because there's so many good fundamental things that they're going to learn from taking that deep dip buy course. So the link's in the description. Do yourself a favor. If you have the $12 or $15 to spare, go ahead, watch it, and you'll be glad you did. Next, if you like today's podcast, I really would appreciate it if you could hit the thumbs up button. It helps to build the channel, helps keep the channel around, lets YouTube know there's some valuable content here. And I have a lot of traders reaching out to me asking for help and suggestions. And, you can help me help them by just hitting the thumbs up button, if you wouldn't mind, or sharing on social media, just anything I would appreciate. And then lastly, and the most important thing, as always, please try to go out and do something nice for someone today. You never know what kind of day they're going through. You never know what just one act of kindness really might change their whole mindset, give them faith in humanity again. But I try to do that every day, just one nice thing, because of course I would appreciate it too if someone did that. And on top of that, if I'm a big animal lover, and if you could do that for an animal, if you could give them a nice act of kindness too, they would appreciate it. The human would appreciate it. It would just make the world a better place. So that's what I try to do every day. And if you could, I just think it would make you feel better as well, because it always makes me feel good. So tough market last week. Are we at a bottom? I have no idea. All we can do is go off of our levels and create those good risk to reward ratios. So stick with your process, be patient, wait for the trade to come to you, position size correctly, and eventually we'll go up somewhere, somehow, right? We definitely will. So I hope you have a good rest of your weekend. I really appreciate you watching this video. I hope it is helpful for you. I really do. If you have any comments or questions, please put them in the comment section. I will do my best, but I wish you a good rest of your week, and I wish you good trading next week. And thanks so much for coming. And on the way out here, I have to run the U.S. legal disclaimer. So thanks a bunch, everyone. Have a great weekend, and God willing, we will see you next week. Thanks. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.